All right, let's get right into it. Today, we're going to pull back the curtain on one of the most powerful ideas in all of investing. We are going way beyond that flashing ticker price you see on your screen to figure out what a company is actually worth. So, let's dive in. I mean, just think about it for a second. A stock's price can shoot up or crash down because of a single news headline, a tweet, you name it. But does the real, fundamental value of a company, a solid business, actually change that quickly? Of course not. And that's the big question we're going to tackle. How do we separate that chaotic day-to-day market price from a company's steady underlying value? And that leads us right to this first huge concept, the massive difference between price and value. You could call this the billion-dollar question. All that noise you see in the market every day, that gives you a price. But a lot of the time, that price has very little to do with the company's actual long-term health and worth. And this really frames it perfectly, doesn't it? The market price? That's often just about emotion. It's about fear, it's about greed, but intrinsic value? That's totally different. That's a calculated guess of what the business is actually worth, based on its assets, its earnings, and how much cash it's going to make down the road. It's what you are really getting for your money. So how in the world do we find this so-called true price? Well, turns out there's a really smart, disciplined way to do it. It's a framework that some of the greatest investors ever, guys like Warren Buffett, have used for decades. It's called value investing. When you boil it all down, value investing is really just about finding amazing bargains. It's like being a world-class bargain hunter. You're looking for fantastic companies that, for one reason or another, the market has overlooked and put on the discount rack. You're not just buying a ticker symbol. You're buying a piece of a real business for less than it's worth. And this all circles back to our most important term today, intrinsic value. This is the number we are trying to find. Now, it's not some magic number that's 100% perfect. It's a reasoned estimate based on cold, hard facts about the business. Think of it as your anchor. It keeps you grounded when the market is going crazy. Okay, so finding a company's intrinsic value isn't about guesswork. And it's definitely not about following some hot tip you heard online. It takes real investigation, what investors call fundamental analysis. You got to put on your detective hat and really start digging. And that detective work really comes down to three main things. First, you pore over the financial statements. That's the company's report card. Second, you have to look at the people running the show, the management. Are they smart? Do you trust them? And third, and this one is so important, you've got to find its economic moat, its special, unique advantage. This is where we get that awesome castle and moat idea, famously talked about by Warren Buffett. He says to think of the best businesses as these incredible, strong castles. And what protects a castle? A moat. For a business, that moat is some kind of sustainable, competitive advantage that keeps the competition out and protects its profits year after year. Okay, so what does a moat actually look like in the real world? It's not a ditch with water, right? Well, think about Apple. Their brand is so powerful. It's a huge moat. Or think about Meta's network effect. Everyone's on their platforms, which makes it more valuable for every single user. You could also have high switching costs, a massive cost advantage like Walmart has, or valuable patents. These are the kinds of powerful defenses we're searching for. Right, so you've done your homework. You've found a great company, and it's got a nice wide moat around it. So how do you actually put a price tag on its intrinsic value? Well, investors have a toolkit with a few different methods, and it's kind of like using different lenses to get a clear picture of the company's worth. And this table breaks down the three big ones really nicely. First up is discounted cash flow, or DCF. This is probably the most detailed one. You basically try to predict all the cash the company will generate in the future and then figure out what that cash is worth in today's money. It works best for really stable, predictable companies. Next, you've got relative valuation. This is like comparison shopping for stocks. You see how a company is priced compared to its rivals using some common ratios. It's awesome for a quick check. And finally, there's asset-based valuation. This asks a super simple question. If you sold off everything the company owns today, what would you get? No single method is perfect, so the pros will often use all three to get a well-rounded view. When we talk about that comparison shopping method, these are the ratios everyone uses. The PE ratio, price to earnings, tells you how much you're paying for every dollar of profit. Price to book, or PB, compares the price to the company's net assets. And price to sales is really handy for companies that aren't profitable yet. By comparing these numbers to other companies in the same industry, you get a quick snapshot of whether a stock looks cheap or expensive. So you've done all the research, you've run the numbers, and you have a pretty good idea of what the company's intrinsic value is. Now what? Well, Here comes the final piece of the puzzle. And honestly, it might be the most important step of all. And this is the principle that ties it all together. It's called the margin of safety. It's a simple idea. You don't buy a stock just because it's trading at its fair price. No, you wait. You wait until it's trading at a big discount to what you think it's worth. That gap, that discount, that's your margin of safety. It's your buffer zone.
This quote just says it all, doesn't it? Because let's be honest, you might be a little bit wrong in your calculation, or something totally unexpected could happen to the business. The margin of safety is what protects you from bad luck, and it protects you from your own mistakes. It's really the foundation of smart defensive investing.
And when it's all said and done, this whole process, all the research, all the number crunching, all the patience, it all boils down to this one simple, powerful goal. Find a wonderful business and buy it for a price that is way less than what it's truly worth. So, the next time you see a stock price flashing green or red on the screen, hopefully this gives you a whole new way to think about it. Instead of just asking, what's the price doing today? Maybe you'll start asking, yeah, but what's the business truly worth? How does having this framework change the way you look at the market? It's definitely something to think about. Thanks for tuning in.